I've worked with hundreds of retirees who've done everything right. They've saved for 30, 40 years, built traditional IRAs worth $800,000, $1 million, and even more. They hear about Roth conversions, decided to do them, and went ahead. And then when they meet me, and I had to show them something that stopped them cold. Because even though they were converting, they were doing it in a way that quietly cost them $30,000, $50,000, and sometimes more in completely avoidable taxes. Not because they did not try, not at all. It's not because the strategy was wrong, but because nobody told them about the 5 specific mistakes that the IRS never points out, and most financial advisors never catch either. Here's the painful part. Some of those mistakes cannot be undone. Once you convert in the wrong year, at the wrong amount, in the wrong way, that tax bill is locked in. But if you're still in the planning phase, or if you have a conversion coming up, this video could save you tens of thousands of dollars. Because today, I'm walking you through the 5 most common Roth conversion mistakes that I see, and exactly how to avoid every single one. Hi, I'm Mark Wisniewski, president of Southern Incomes. I help pre-retirees and retirees build tax-efficient income plans so that they can keep more of what they've worked their entire lives to build. And when it comes to Roth conversions, I've seen the full spectrum, the people who did them brilliantly and the people who left a staggering amount of money on the table. In this video, we're going to cover mistake number 1, the way almost everyone pays the conversion tax and why it's quietly shrinking your Roth. Mistake number 2, converting in the wrong year and handing the IRS more than you owe. Mistake number 3, the all or nothing trap that triggers Medicare surcharge that most people never see coming. Mistake number 4, waiting too long and losing the most valuable window you'll ever have. And mistake 5, the legacy mistake that forces your kids or your heirs to pay your tax bill after you're gone. If you find this helpful, hit subscribe and like the video. And if you want to know which of these mistakes might be in your conversion plan right now, there's a link in the description to book a time with me directly. Now let's get into it. Mistake number 1, paying the tax bill from your IRA. This is easily the most common mistake I see, and it costs people more than any other single decision in this entire conversion process. Here's what happens. You decide to convert $100,000 from your traditional IRA to a Roth. So your brokerage is going to ask you, how do you want to handle the taxes? And most people just say, just withhold them. The brokerage then is going to withhold $22,000 for federal taxes, and the remaining $78,000 is going to land in your Roth. It sounds reasonable, right? You owe the tax, you paid it, everything's done. But here's what you did not realize. That $22,000 that never made it into your Roth, whoosh, gone forever. Gone from your tax-free account. It will never grow tax-free. It will never come out tax-free. You just permanently reduced the money that's working for you inside of that Roth and paid the IRS with dollars that could have been compounding for the next 10 or 20 years. Here's how it actually works when you do it right. You convert the full $100,000 into the Roth. Then you pay that $22,000 tax bill from your taxable brokerage account, or maybe a checking account, using money that was already outside the IRA. Same tax bill, but now $100,000 is inside the Roth instead of just that $78,000. Let me show you what this means in real numbers. I had a client, let's call her Patricia, who was converting $200,000 from her IRA. She was going to withhold $60,000 for taxes, putting only $140,000 inside of the Roth. We stopped and paid that $60,000 from her brokerage account instead. The extra $60,000 that stayed in that Roth, well, based on her historical growth, it's now worth somewhere over $90,000, completely tax-free. That's $30,000 in tax-free growth she would have permanently lost by making one default choice at the wrong moment. The rule is simple. Never pay Roth conversion taxes by withholding from the IRA itself. Always pay from outside money. That one change alone is worth thousands to you. And the exception to this, of course, is if you don't have cash outside of the IRA, you have to withhold. Mistake number 2, converting in a high income year. Here's where timing can either save you or cost you a staggering amount. Most people think about whether to convert. Very few think carefully about when. And the difference between the right year and the wrong year, it can mean paying 12% on that conversion or paying 32% on the same money. Here's the problem. I see retirees who are still working when they start converting, or they've just begun Social Security, or sometimes they sold a rental property that exact year, or maybe their pension kicks in. And then they convert $80,000 on top of all of that income. Suddenly, they're in a bracket they never ever expected to be in. That conversion should have cost them a little under $10,000, maybe $9,600 in taxes. It's now going to cost them $25,600 instead. But because the timing was wrong. Here's the window most people miss. There's a gap between the day that you retire and the day Social Security and RMDs, those required minimum distributions, begin. For many retirees, that gap runs from roughly age, I'd say 62 to 72, or maybe even 73. No paycheck, no Social Security yet, no forced IRA withdrawals. That's your golden window. Your taxable income may be lower during those years than any other point in your entire adult life. That's when the 12% bracket has room in it. That's when a $50,000 conversion costs $6,000 in taxes, not $16,000 in taxes. Wait until you're 74, when RMDs are stacking on top of Social Security, and that same conversion happens on your top bracket. You've just paid 2 to 3 times as much on the same amount of money in taxes. The window is real. It's temporary, and once it closes, it's gone. Mistake number 3, converting too much all at once. The IRMAA cliff. Now let's talk about the mistake that blindsides even financially savvy retirees, because the damage doesn't show up until 2 years later. Most people know about marginal tax brackets. What they don't know is that there's a second set of income thresholds called IRMAA that determines your Medicare Part B and Part D premiums. And unlike tax brackets, IRMAA, it works like a cliff. Here's what I mean by that. A married couple filing jointly with income below $206,000 pays the standard Medicare premium. Cross that line by even $1, and they're already in the first IRMAA tier. So that's roughly $70 per month more per person, or about $1,680 extra per year. But here's the part that trips most people up. IRMAA is calculated based on your income from 2 years ago. So if you decide to do a large Roth conversion in, say, 2026, you don't feel the Medicare hit until 2028. And by the time you notice, you've already crossed that threshold twice. Let me tell you about 2 clients, Robert and Carol. Both are 65, both retired, both with about $1.2 million in their IRAs. Both decide that they want to convert a large chunk. So Robert converts $250,000 in one single year. He's excited. He's moving a lot into a Roth quickly, and that makes him feel good. But that conversion pushes him into MAGI, modified adjusted gross income, of $310,000, deep into the second IRMAA tier. 2 years later, he's paying an extra $4,200 per year in Medicare premiums. For both him and Carol, that's $8,400 a year for 2 years. That brought them to $16,800 in unexpected Medicare costs on top of the conversion tax that he already paid. Now Carol decides to convert $100,000 each year for 3 years. So the same total amount, she stays just below the first IRMAA threshold every single year. Same money moved to the Roth, but she avoids the entire Medicare surcharge. Same total conversion, same destination, but Carol kept $16,800 that Robert just handed back to the government. She did it simply by pacing her conversions correctly. And the fix is not to avoid large conversions, it's to know your thresholds and convert up to them, not past them. Every year you should be asking, how much can I convert and still stay below the next IRMAA cliff? That is the discipline that separates a good conversion plan from a really great one. Mistake number 4, waiting until it's too late. This is one of the hardest to talk about because once it happens, there's very little you can do. I get calls, too many calls, from people in their early 70s who have just received their very first RMD, that's required minimum distribution letter, from the IRS. So they're looking at it, doing the math, and realizing that their $1.4 million IRA is going to force them to take out $55,000 this year. And whether they need the money or not, it's coming out. And then they say, Mark, I've been meaning to do Roth conversions. Can I still do them? Well, the answer is yes, but it's harder now because you now have to take that RMD first, then you can convert on top of that. So you can see your taxable income this year starts at $55,000 before you've done one single conversion. Add Social Security, which could easily be $30,000 to $40,000, and now you've used up most of your lower brackets before you've moved a single dollar into that Roth IRA. The window isn't fully closed, but it's much narrower, and it's getting narrower every year as the IRA grows and the RMDs increase. Compare that to a person who started converting at, say, age 62. They had 11 years of that golden window to convert, moving maybe $50,000 to $80,000 per year at 12% and 22% rates. By the time their RMDs start, their traditional IRA is dramatically smaller. Their first RMD might be $20,000 instead of that $55,000 forced withdrawal. Their brackets have room again. And their Roth, it's been growing tax-free for over a decade. The most valuable thing I can tell you is this. The time to start is not when you're forced to. The time to start when you're first free of a paycheck, because that's when your income is lowest. Your brackets are most open, and every dollar you move costs the least amount in taxes. If you're in your late 50s or early 60s right now, this is your moment. Right now. Do not wait. Mistake number 5, leaving your kids with a tax bomb. Here's a mistake that has nothing to do with your own retirement and everything to do with what your family inherits. Most people assume that leaving a large IRA to their children is going to be a generous gift, and it can be. But thanks to a law called the Secure Act that was passed in 2019, most Non-spouse beneficiaries now have to completely empty an inherited IRA within 10 years of the owner's death. Think about what that means. Your child or heir who's, say, 45 or 50 years old at the peak of their earning years suddenly has to take distributions from a $1 million IRA and fold that income into their already high salary. They could easily be in the 32% or 37% federal tax bracket. And add state income tax on top of that in California or New York, and nearly half of the money that you worked a lifetime to save goes straight to the government. You spent decades deferring those taxes to grow your wealth. Your kids end up paying them at the worst possible time. Now, compare that to inheriting a Roth IRA. The 10-year rule still applies. They still have to empty it within 10 years, but Roth distributions, still tax-free. Every dollar comes out with no federal income tax, no state income tax, no impact on their brackets. The difference isn't hypothetical. On a $1 million inherited IRA, a child in the 35% combined tax bracket, rather than walking away with roughly $650,000 after taxes, now they're looking at that same $1 million Roth IRA coming out as $1 million, every penny intact. That is the difference between leaving your family a gift and leaving with a big, big tax bill. And this is why doing Roth conversions, even partially, even gradually during that golden window, isn't just about your tax efficiency. Well, it's about protecting what you're going to leave behind. The big picture. These mistakes are all fixable. Here's what I want you to take away from all of this. None of these mistakes mean that you're bad at planning. They do mean that you were never shown the right way to plan. Roth conversions are clearly one of the most powerful tools in retirement. But just like any old tool used incorrectly, it doesn't just fail to help, it could actually hurt you. Paying taxes from the wrong account, converting in the wrong year, crossing the Medicare cliff, waiting past the window, or ignoring the legacy impact, these are all decisions that feel invisible at the moment, but so painful in hindsight. But here's what's true. If you haven't started converting yet, or if you started converting, but you haven't been doing it strategically, there's still time to course correct. The goal isn't to panic. The goal, well, it's to plan, to look at your income picture, your tax brackets, your IRMAA thresholds, and your timeline, and build a conversion strategy that works for you, not against you. Because Roth conversions done right don't feel like a sacrifice. Well, they feel like freedom, the freedom to take income in retirement and not owe a dime to the IRS, the freedom to leave your kids something that they're actually going to keep, the freedom to stop letting the tax code control your retirement and start controlling it yourself. That's the retirement that you worked for. If any of these mistakes sound familiar, or if you're not sure whether your current conversion strategy is being optimized, let's talk. Book a complimentary retirement strategy call using a link in the description. We'll walk through your current IRA and Roth balances, your projected income in retirement, and when RMDs will begin. And we'll work to find your ideal annual conversion amount to stay in the right bracket without crossing that IRMAA threshold. There's no generic advice here, just your numbers, your timeline, and a clear plan for exactly how much to convert in which years and how to pay taxes as efficiently as possible. So if that sounds helpful, use the link in the description to book a time with me. And if this video gave you something valuable today, please hit like, subscribe, and maybe share it with someone you know who's planning their retirement. They might be making one of these very same mistakes right now and not even know it. Thanks for watching. I'm Mark Wisniewski, and I'll see you in the next one.